Well, hello, everyone, and welcome to Fiducient Advisors Mid-Year Capital Markets and Economic Review. My name is Chris Kachmar. I'm a partner at the firm and Chief Market Strategist, and I'm joined today by my colleague, Matt Rice, our Managing Partner and Chief Investment Officer. And Matt and I intend over the course of the next half hour or so to catch up on markets and dig a little bit into some of the things that you've been reading about that have been affecting markets, certainly the Fed and its activity, to get its control on inflation, and moreover, some of the concerns about recession talk, and bring those topics together and hopefully give you a couple of thoughts as to what prospects might be for markets on a go-forward basis in the second half of the year. So with that, let's just jump into some returns and look a little bit about what's going on. Obviously, investors have been confronted by higher volatility and pretty sharp downward movements across capital markets, and uniformly so, as you see here evidenced on the page. There really have not been, unfortunately, places to hide calendar year to date, and kind of that trend carried on, as you can see, in the second quarter with largely negative returns also. What's maybe particularly striking about this page is we're often accustomed as investors, when we see downdrafts and risk appetite for equity markets, for example, to consolidate. We're not quite as accustomed to seeing that same level of consolidation in the fixed income markets. And certainly, as you see there in the exhibit on the left-hand side of the page with the dark blue bars, fixed income markets have been uniformly negative year to date as well. And that's been, I think, particularly troublesome and concerning to investors. And that is carried over, of course, broadly into global equity markets, as you see there in the middle of the page, with large cap stocks here in the US down about 21% through June, and moreover, uniformly negative returns across the balance of global equity markets. A little bit of measure of relief, I suppose, in the emerging markets on a relative basis, particularly toward the end of the second quarter as China softened up on some of their COVID close down protocols. And then there has been, given the inflation backdrop and some of the challenges with supply chains and bottlenecks and just the commodity complex more broadly, a measure of relief there, I suppose, as you see commodities have been the one source of a positive return through the middle of the year. So challenging times indeed. And if we dig a little bit deeper, just in terms of what's gone on across equity markets and fixed income markets, if we could turn, Chris, into the next page, just to give folks a little bit of context, right? I think that context is always kind of important and necessary. And you see here, we've cataloged downdrafts in equity markets, and they happen, I think, as we all know, fairly frequently. And just to point to the particular environment that we're in currently, you do see, right, we're down about 20% year to date, as mentioned. That happens about once every 6 years, as you see in the medium blue shaded bar in the exhibit in the lower right-hand corner of the page. What's, I think, caught investors and ourselves by surprise, right, has been how rapidly that downdraft has occurred. As you can see there, it's taken about just half the time it typically does to see that magnitude of a downdraft as investors recalibrate again around the Fed, and the war and the lingering effects of COVID have certainly all been enduring headwinds here. But they downdrafts are frequent, consolidations are frequent. They're certainly what we would think a normal part of the investing process, and a necessary part of a healthy investment process as well. And while the numbers aren't on the page here, just from a context perspective, even through June, think what the S&P has done over the last several years, right? So for many of you that work with us know that we tend to be disciplined, kind of patient investors, and you are as well. And the S&P 500, for example, through June, 3 years is up 10.6%, 5 years is up over 11%, 10-year period ending in June up 13%. So on the heels of what has been a very healthy run in equity markets, we have had this point of consolidation as the markets again adjust to this ever-evolving set of circumstances on a go-forward basis. On the fixed income front, again, I mentioned just a moment ago, right, it's been surprising and certainly dramatic, the downward movement in fixed income returns year to date. You see here on the page, we've cataloged the aggregate bond index since the mid-1970s, and you can see the path of returns over several calendar years, and lo and behold, no surprise, you see the very emboldened a stream of data there at the bottom of the page, calendar year to date 2022, right? And that is pretty amazing and certainly a surprising statistic in the sense of the dislocation and its magnitude. But think about, again, from a context perspective, where we started the year, 10-year treasury yields were at about 93 basis points. They were close to 3% or just shy of that at the end of June. And you can appreciate when you get that type of a rate move, that is certainly going to pressure fixed income returns. And moreover, just in terms of kind of consistent with this reduction in risk appetite that we've talked about and introduced, you've seen that in certain segments of the fixed income markets as well. We now have spreads for investment grade paper trading through their 10-year averages and have widened out again as investors seek additional compensation, and that obviously is a headwind as well. So nothing new here for our listeners. Certainly it's been a difficult year to date, and we'll begin to unpack some of those reasons why here with Matt working you through the inflation and Fed conversation. Matt?
Great, thanks, Chris. And just to remember, please, you feel free as we go through this presentation. If you have any questions, leave them in the chat. We're happy to address those along the way or at the end. Just as we look at this slide 9, just putting in context this current level of inflation that we're seeing running at 9% year over year. You have to go back really to 1981 to see an environment similar to this. So this is why this feels very painful for a lot of us. For there's generations that haven't really seen this kind of inflation level, and this is really creating it's the primary focus of the Fed going forward. And unlike some of the other periods that we've had over the last couple of decades, the Fed really has to focus on one thing right now and put it first, and that's controlling inflation. As we continue to work our way through the deck here, this is really looking at expectations on a go-forward basis. So markets are now anticipating a much higher Fed funds rate by year end than they were just a quarter ago. And just remember, the market does not move based on kind of events; it moves based on future expectations about events. And if we look at really towards the end of the year, we're seeing that just in the last quarter alone, kind of a 100 basis point increase in expectation about where the year-end Fed funds rate. And so when we look at that, we see really bond markets reacting and kind of equity markets reacting with a fundamental repricing of really all financial assets across the board. And then we look at evidence of financial conditions tightening throughout the economy. If you go back and look at this chart throughout history, you can see the very, very right side just shows this little blue arrow you can see on the bottom right where we're heading up. And this is the Chicago Fed National Financial Conditions Index. So it's a measure of kind of financial conditions. And then you can see, obviously, during COVID, things peaked up in early 2020. And then if you go back to the financial crisis, you can see what, how tight conditions got during the 08-09 period. So we're still below that zero line, but you can see the trend is heading significantly towards really that tightening phase. So while we're talking about really inflation hitting 40-year highs, it's interesting. If you look at the TIPS break-even level, so you can take the 10-year nominal treasury, compare it to the 10-year treasury inflation-protected security, and the difference between those yields is the implied market expectation, or the bond market's expectation for inflation over the next 10 years. If you're looking at the 10-year securities, or if you're looking at the 5-year securities, the 5-year inflation level. And you can see that despite the fact that inflation has kind of continued to trend up, the market over the last quarter has expected really inflation over the next 10 years to begin to come down which is a healthy, which is an optimistic outlook. So if you look really here at the 5-year break even, it was about 3.5 in March of 2022. Now it's down to about 2.5%. So the market really expecting that the Fed will get inflation under control. So that's a kind of a shift in expectation. Is perhaps a quarter ago the Fed had less credibility on that than they have now. As the Fed's gotten more hawkish, the market has kind of responded with that expectation that inflation levels will begin to come down. So while we're running at 9% now, the bond market really expects over the next 10 years for that inflation number to get back down into the 2.5 or less level for that period. Okay, I'll turn it back over to Chris here to talk about whether there's a recession on the horizon.
Thanks, Matt. And maybe two things before we get started, just in terms of questions. I am kind of cataloging these as best we can here. And maybe, Matt, if you would, there was one question, and it just on the heels of your comments on the Fed there, a question was asked, does the Fed actually need to raise rates to 9%? I think the question from the individual kind of centers on the idea that is, are we kind of in a runaway scenario, and how dramatically and emphatically does the Fed have to move to get things under control? Any thoughts beyond what you just said on that front?
Yeah, I will say that if inflation doesn't start to come down in the coming months and the coming quarters, history is that it's the Fed fund rate typically stays in lockstep with inflation over time. So if inflation is running at this 9% level, you would need the Fed funds rate to eventually, or interest rates to adjust for that. So we have right now, with kind of a slowdown in the economy that we're seeing, and this addresses another question, kind of a little bit of demand destruction occurring, pulling back on some of the commodity prices that we're seeing, that if we can see inflation begin to level off here below 9 to 8 to 7 to 6, and over the course of the next 3 to 6 months, then no, we do not need to raise interest rates all the way on up to 9. But that is a meaningful risk right now, that if inflation doesn't start to respond to some of these hikes and really a slowdown in the economy, then we will have to see the Fed continue to get more aggressive than what's kind of baked into those numbers now, as we talked about earlier, with a Fed funds rate expectation of closer to 3.5 to maybe 4 by year end. That will have to come up if we don't see some of those inflation numbers come down.
Right. I'll forge ahead here. As Matt mentioned, let's talk a little bit about the macroeconomic landscape, if we could. And one of the ways to get at that is looking at the leading indicators index that the Conference Board puts together. And you can see here over time, these kind of sharp downward movements in the index, kind of in front of and alongside recessionary periods, which you see are the gray vertical bars there, and a fairly consistent relationship between the two, even as recently as we know in that very mini recession that we had back at the onset of the pandemic. But if you work your way all the way over to the right-hand side of the graphic, you do see things turning over a little bit. Right, kind of this, and leading indicators, obviously, the index is designed as kind of an anticipatory mechanism to get a handle on these rotations in the business cycle. And there's certainly, something going on with the numbers here, right, as we kind of soften away from those peaks, kind of consistent, I think, with the larger narrative, right, that we are seeing certain economic data begin to soften a bit. What is interesting and important here, of course, is that we haven't turned all the way over yet, and don't in fact have a negative reading on the index just yet, right? So could that potentially be a path to a mild recession, maybe just a period of diminished growth? We'll see how that all plays out. But certainly at the very highest level, we have seen some softening in some of the data. And if we jump, Kristen, to the next page, just kind of another set of data that kind of shares that same kind of direction, if you will, are some of the PMI indices here. We've cataloged for you both the manufacturing and services indices. You see to the far right in the exhibit, again, kind of consistent with what we saw with LEI, right? This rollover of some of that data and the beginnings of some softening and moving back down toward that 50 threshold. Remember that the way these indices are set up above 50 is indicative of an expansionary environment. Below is contracting environment. So again, softening, but not a complete deterioration in those numbers just yet. And it's kind of joined by a little bit of a softer sentiment on the consumer confidence front. You see the lime green line there. That number starting to roll over a little bit as well, and starting to approach levels that we haven't seen since I think the winter of 2021. So this larger story around the data beginning to soften a bit is certainly something we're spending time on. And let's work through the data if we could a little bit more, Kristen, if we jump to the next page. GDP growth expectations. And this is an Atlanta Fed number, right? It's designed to try to get a handle on where GDP numbers might come in. Just from a context perspective for the listeners, you'll remember the third quarter, the third estimate, if you will, from the Bureau of Economic Analysis came in at minus 1.6% for Q1. And if you look in the very lower right-hand corner of the exhibit here, this index is generated weekly. The July 15th number is minus 1.5%, right? You link those together, I suppose that's a practitioner's definition of a recession, a mild one, if it comes to pass, but a recession nonetheless. Certainly, again, something that we're spending a lot of time monitoring. It's interesting from a context perspective. Recessions typically last about 11 months. If you look at the last 4, we've experienced that time frames varied a little bit. We had the mini recession back at the onset of the pandemic that was maybe 2 months' time. The great financial recession lasted about 18 months. And then we had the dot-com recession, and then for some of our older listeners, the Gulf War recession. Those were both about 8 months. Right, so it kind of gives you some context and maybe bracketing around what we're experiencing currently. We bring all this data together again, and right, what we're kind of thinking about on your behalf is, what that path may be through in terms of how severe, if in fact a recession occurs, how severe can it be? Is there the probability of some type of a soft landing still? And is a lot of the discounting mechanism we've seen in capital markets year to date kind of caught up or in front of some of this softening macroeconomic data that we're seeing? So if we could, Kristen, turn to the next page, some of the kind of the countervailing influences in the markets that I think we've written and talked to you about over the last several months centers on what remains a very strong labor market. You see here, we are depicting number of unemployed per job opening. And you can see in the very lower right-hand corner of the page, that number continues to plot, if you will, and indicate a very tight labor market. And in some ways, right, that could be a tailwind, as we mentioned in the top of the page, for additional wage growth. I think wages are up about 5% for the 12-month period ending in June. And it could be a source of resiliency for consumers, right, as they kind of navigate their way through some of this inflationary pressure and some of the softness we're seeing macroeconomically. If we jump, Kristen, to the next page, another metric, payroll growth. See that here again, kind of that interesting relationship, right, where you see fairly sharp declines in payroll growth associate with recessions. Again, you see the vertical bars there and get that relationship. And to the far right, we have had a bit of softening, but job growth, all things equal, remains very solid, right? I think the June number that we just saw came in at 372,000 jobs against a 250,000 estimate. And again, indicative that, all things equal, the labor markets remain in fairly decent shape. And then finally, if we pair that just with kind of the financial condition of consumers on the next page, Kristen, we'll see that data. You see here just consumer net worth as a percent of disposable income, right? And I know many of you have read about this, and it's been kind of discussed with a good deal of frequency in kind of financial circles. You see there to the far right, consumers, all things equal, remain in very solid shape financially. So, these are things, again, to us around this thought of, could this downdraft, if in fact we have one, be a relatively mild one? And can strong labor markets and pretty solid consumer health, again, be barriers to a complete collapse of economic activity? And moreover, does this kind of present to them, of this data maybe present to the Fed a little bit of confidence in their thoughts that maybe the markets can in fact, consume a little bit more of some of the pain we've seen on the policy front. So that kind of takes us through the economics. Matt's going to walk us here through the just expectations for markets on the back half of the year. One question, Matt, that I did write down that someone asked, and I'm sure you'll get to it: any changes that we may have made in portfolios or positioning as we kind of see what we've seen year to date and on a go forward basis?
Yeah, it's a great question, Chris. When we revised our capital market assumptions mid-year, and what we saw was generally a broad repricing of asset classes across the board, across fixed income, equity, as Chris laid out earlier in the presentation. So as a result of that, we are seeing some portfolios beginning to enter some of the rebalancing territory, but from a fundamental perspective, global equities have all sold off kind of in tandem. We have the bond markets overall, high yield, investment grade, and so on and so forth, all kind of selling off in tandem. So we are not seeing any sort of meaningful shifts in portfolio allocations. And most of our efforts have been focused on the rebalancing side of things. With that, by the way, thank you for all the questions. There's so many coming in that we may have a hard time getting through all of them. But we'll do our best. As we go through here and look at this slide, market returns versus business cycle, I think it's important to keep this in mind, that I know a lot of people right now are obviously focused on, are we entering a recession? And that's an obvious question to be asking, but oftentimes that's not instructive if you're trying to time markets. And why is that? Well, markets often bottom before folks even know that we're in a recession. And that's kind of been a historical dynamic. Just to kind of put a little bit of information behind this, if we look at really the average recession dating back to 1950, markets peak about 7 months ahead of the economic top, and then bottom out 3 to 4 months before the economy begins to grow again. And I think that's important to know, is that there's kind of a significant lag between what the economy is doing typically and what the equity markets are doing. And as a result, for example, we haven't officially entered a recession yet, and there's some talk that it's possible that it could happen fairly soon, depending on how the second quarter GDP numbers. It would be a mild recession if it happens, but the market is already sold off about 20%. As we look here, and just to add a little bit more information behind that if we look at the 6 months before the onset of recession, even on average, there hasn't been a significant sell-off. There's, if you look back to 2001, for example, maybe an 18% sell-off, but the 6 months before the onset of a recession have not necessarily led to a sell-off in markets. And then we look at the onset of the recession until the end of the recession. On average, markets are down about 12.5%. And then one thing to keep in mind is that the onset of recession plus 3 years, 35.7% return cumulatively, and then 5 years later, 91% return. And this is why, hey, we're in a recession. Now is the time to get out of markets. That's not a winning strategy to deploy. And if we look here, just since the beginning of the year, I think this is a helpful slide. We went into the year early in our outlook saying that interest rates were low and rising. We had equity valuations were on the high side. If we look at really what the first 6 months has done to market valuations, We look at the US here, and you go back to 12/31/2021, that little gray circle on the upper left-hand side, you can see we were outside one standard deviation in terms of valuation on the high side in the S&P 500. Since the end of last year, and we look at this same metric, June 30th this year, we are now below median valuation. So if we go out over the last 15 years, and we look at the historical average valuation going back over the last 15 years, we're now below average from a price to earnings valuation perspective compared to where we've been. So this has been a meaningfully repriced, really, valuations in the United States. And then we look at international and emerging, it's even more pronounced, where we had a little less high valuations relative to historical averages going into this period. But now both international and emerging are nearing that one standard deviation on the low end of historical valuation range for the last 15 years. And then we look here at this slide. This is shows the starting yield for or looks at really the 10-year US Treasury going back all the way back to 1975. And then what we're looking at with the dark blue, that's what the dark blue is. With the light blue is the Bloomberg US Aggregate Bond Index over the subsequent 10 years, the return associated with that. And you can see that forecasting bond returns has not been significantly difficult. If you've done it historically, the current yield is a very good predictor of where returns will be. And so the market certainly within bonds gave us lemons, having the significant bond market sell-off where we've seen interest rates really increase 2% since the beginning of the year. You can see that both in the 10-year Treasury yield from 0.93 to 2.98, and then the Bloomberg US Aggregate from 1.76 to 3.72. Both of those have moved up. So the lemons are that we've had this kind of significant reduction in bond prices, over a 10% sell-off overall. But the lemonade is that now, on a go-forward basis, bonds, we expect to compound capital at a 2% higher return, which over the long term is really the best thing that can happen to bonds, is that we see this increase in yield. So nobody likes living through the last 3 to 6 months where we've seen bond markets sell off, but on a go-forward basis, we see bonds now priced to give us a healthy positive real return expectation when we look at where the bond market is pricing inflation. And when we look at bond yields, we're seeing a healthy positive real return expectations for the first time in quite some time. With that, thank you all for joining us. I think we're going to try to hit a couple more questions here before we depart. I'll turn it over to Chris, as he's been probably busy reading some of the questions here.
And I think Matt, it probably follows on the heels of your earlier discussion there. Certainly inflation is the topic du jour for sure. And there are two questions that I think I can fold into one here for you. One just relates to how much does the China lockdown and the Russian-Ukraine situation figure into the recent inflation statistics? Is it an outside influence, and is it something, I suppose, that could wane over time as those circumstances hopefully resolve themselves? And then there's something related as well to commodities just broadly, and whether that's a technical or kind of a fundamentally driven a thing that we've seen more recently on the commodity front.
Yeah, well, I'll say, before the war in Ukraine started, we already had significant inflationary pressures hitting. But no doubt the war in Ukraine added some gasoline to the fire already, where we saw really, we kind of threw an oil shock on top of inflationary pressures. And so certainly that the war has not had an insignificant impact, but we were certainly facing significant inflationary pressures even before the war occurred. And then I'll, talking a little bit about China and the COVID lockdowns. No doubt there's kind of this ongoing supply chain disruption that's really been more of a supply side cause of inflationary forces, whether it's China doing lockdowns and creating, everybody waiting for one part on the assembly line that they can't finish the product certainly is, whether it's cars or other things, certainly creates a significant problem. And that the problem with that is the Fed is not equipped and cannot handle supply-driven issues when it comes to inflation. All the Fed can do is control demand to a certain extent by raising the cost of money or interest rates. And so, and I think that one of the questions, other questions, dovetails nicely into the one that Chris mentioned. Is it more of a technical or fundamental repricing that we're seeing within commodities? I think it's largely signs that we're beginning to see kind of a little bit of destruction in demand, which is the only way really we're going to begin to get inflation under control until the supply chain bottlenecks can work. Is the Fed can control the demand side, but they can't really control the supply side with the inflation bottleneck. So our view is that it's more the kind of the reduction that we've seen in commodity prices has been more on the demand front than the supply front as of late. Although when we throw on top of that, the U.S. has been releasing a lot of oil from the Strategic Petroleum Reserve as well, which has certainly contributed to kind of a reduction in some of the energy prices.
I think we're running right up on our time now, and we do want to be respectful of folks' time. I know your schedules are busy. We appreciate you spending a half hour with us today to catch up on markets. Certainly to the extent we didn't get to one of your questions, please reach out to your consultant or advisor. We'd be happy to follow up with some information. And then as well as some of you may have seen, our redesigned website is constantly being updated with new information from our research team and new perspectives on the markets. And we would encourage you to visit that as well as a source of information. So I think with that, maybe we're right up on our time, and we would bid you a good day.
Thank you so much.